This is the Hacking Real Estate Podcast, Episode 4.
If I buy a house today with the intent of flipping it, renovating it, and then reselling it, by the time I'm done renovating it in 2 or 3 or 4 months, the market may have gone down 10 or 15%.
Welcome to the Hacking Real Estate Podcast, where we dive into the stories of seasoned, hands-on, and tech-savvy real estate investors. We'll learn the strategies and tools they use to maximize returns and minimize hassle, all while navigating the rapidly changing real estate market. I'm your co-host, Brandon Hall, and managing partner of Hall CPA, and I'm sitting alongside my co-host, Vikas Gupta, CEO of Azebo. With our combined 15 years of experience in real estate investing and entrepreneurship, we're here to help you up your real estate game. Let's get hacking. Welcome back. Our guest today is Jay Scott, entrepreneur, investor, and co-host of the Bigger Pockets Business Podcast. Jay has built, rehabbed, sold, syndicated, and held over $70 million in residential property and currently owns hundreds of units. He's also the author of 4 best-selling books on real estate investing, several of which I have read and can attest to. Jay, thanks so much for being here.
Brandon, thrilled to be here. Thanks for having me.
Absolutely. Tell our listeners a little bit about yourself. I know that your background is extensive, so give us a high level.
High level. I am an engineer and business guy by education and mindset. So actually, before I started investing in real estate in 2008, I have an electrical engineering degree, and I spent much of my career in Silicon Valley, working for a couple big companies out there. I spent about a decade at Microsoft, running product for their interactive television division. And spent a few years at eBay where I met my wife. And so I come from the tech world, but 2008, my wife and I decided to get married, and we weren't thrilled with the 80-hour weeks, with the traveling 3.5 weeks a month. And so we decided to quit our jobs and move back east and figure out something that would be more conducive to raising a family and putting kind of family and lifestyle ahead of work. And we fell into real estate in 2008. And since 2008, we have been focused on the residential space. So we flipped about 450 houses between 2008 and 2016. And since about 2018, we've been focused on multifamily syndication. So buying, repositioning, and reselling apartment complexes around the country.
How did you fall into real estate?
It's a very uninteresting story. It was not planned at all. Much of this is much of my story is things just happened serendipitously. My wife and I were sitting on the couch in our basement in 2008. We had just left our jobs in Silicon Valley, moved to Atlanta, Georgia. We were getting ready to get married, and we were trying to figure out what came next. And we had been talking about maybe we start a business, maybe we buy a franchise, maybe we invest passively in real estate. But it never occurred to us to actually actively invest in real estate. But 2008 summer, we're sitting on our couch in our basement watching TV. And for anybody that was watching TV in the summer of 2008, pretty much the only thing on TV back then were these flip shows on A&E and all those other stations. And my wife saw somebody who was flipping a house. It happened to be a house that was a couple miles from where we lived. It got her intrigued. We ended up driving by the house, and she's like, "There's the house that was on TV. We should flip a house." And I thought she was kidding, but she was very serious. She's like, let's flip a house. We don't have anything else going on right now, and it would be a fun thing to do. I'm more the engineer type, but she's more the marketing and design type person. So she loved the idea of getting to redesign a house and lay it out and buy the finishes and all that stuff. So summer of 2008, we decided that we were going to flip our first house, and 1 turned to 2, turned to 5, 10, 50, 100, and several hundred. And before we knew it, that thing that we were trying to figure out what we were going to end up doing ended up being real estate.
So I find it really interesting that you quit your job and then got into real estate, because most people, or almost all the people that I talk to, keep their job and get into real estate. So it's just interesting to point that out. Now, summer 2008, how did that align with the market crash? Was the market already crashing? Had it already crashed when you picked up that first flip, or was that pre-crash?
We were very lucky with timing. It certainly hadn't fully crashed by the time we started. We saw the first big part of the downturn values were probably down 10 to 20%. There was another 10 or 20% to go in our market. I think total we were down somewhere, depending on the specific area, between 20 and 40%. So Atlanta got hit tremendously hard, but we did miss that first big drop. And so we thought we were getting in at a pretty good time. Turns out that there was still some drop to go, but it wasn't as bad as a lot of people who had been investing in 2006 and 2007. So it was good in the sense that we learned a lot of lessons. There are a lot of things that had we started investing 6 or 12 months later, we would have avoided a lot of the issues that we ran into just because the market improved relatively quickly in 2009 and 10. But I think what we did run into, the issues that we ran into and getting into the market when there was still some downturn left to be had, it taught us a lot. It really forced us to focus on the fundamentals. It forced us to really get our heads around how macroeconomic trends impact real estate, how local markets impact real estate. And it really made us button up our systems and processes because had we started a year or two later, things would have been pretty easy and we never would have had to face the challenges we did. And so those challenges actually have served us well over the past 15 years because it hasn't always been easy.
Are you seeing anything, or what are you seeing in today's environment that reminds you?
It's funny. Certainly there's a lot of things that are similar to 2008 in terms of consumer sentiment. I see a lot of people who are fearful. If you just look at consumer sentiment numbers, we're in the toilet these days, like we were actually worse than we were in 2008. So people are fearful. People are recognize that we're heading into a softening in the market, and nobody knows if it's going to be a big one or a small one. I mean, recessions come in all sizes and shapes, and so we don't know what kind of recession it's going to be. But I think everybody recognizes that we're heading towards a recession. And I think there are a lot of people, especially those under 30, 35 years old, which is a lot of real estate investors. There are a lot of people who, if you ask them to describe a recession, the only recession they remember is 2008. And so in their mind, when they hear the word recession, what they think of is 2008. They don't think of the 34 recessions that we had in the 160 years prior, where, things weren't good. Unemployment went up and people were struggling and people were going through bankruptcies and foreclosures. But it wasn't 2008. It was a tough time where subsections of the economy did really poorly. Certain people did really poorly. But overall, we didn't see major bank failures. We didn't see real estate values dropping 10 or 20 or 30 or 50%. We didn't see rents dropping. Literally, 2008 was one of the first times in history where on a national level, we saw rents drop. And so what a lot of people tend to think of as a recession is this 2008 type event. But in reality, we've seen a lot of recessions in this country prior to 2008. And with the exception of one of them, which was the Great Depression 100 years ago, with the exception of that one, none of them have even been close to a 2008 style event. So while I see a lot of people who are tremendously concerned right now and are fearing a 2008 type event, I'm hopeful that that's a little bit exaggerated. And I'm hopeful that what we actually see is more like a 2001 event or a 1992 event or 1989 or any of the 4 recessions between 1968 and 1972 or any of the ones before that where, it's not going to be fun, but it's not going to be anything like 2008.
So something a little bit more mild makes us a little uncomfortable, but not losing our minds scared.
Yeah, and that's my hope. And so in terms of prediction, I think I've fallen a little bit into that whole fear spiral, and I think I'm probably a little bit more pessimistic now than I would be if I weren't seeing so much pessimism around me. Certainly there's indications that things aren't great right now. Inflation is really high. We've seen high inflation before, but historically we raise interest rates and that kind of quashes inflation. And we're not seeing inflation kind of react to interest rates the way they have in the past. We've printed a lot of money over the last, certainly 15 years, but definitely in the last 3 or 4 years. We've printed a lot of money that's impacting just the price of goods in general. We're seeing supply chain issues still that we can't really fix. And so there are a whole lot of issues today that I know every time we go into a recession, there are going to be unique issues that always look like they're terrible and they're going to lead to some domino effect that's going to destroy the economy. Normally it doesn't. And so I'm hopeful this time, just like in past recessions, what we're seeing today, the high inflation, the higher interest rates, the supply chain issues, and all the other things we're seeing, hopefully they're not going to domino. And hopefully, again, it's all of us being a little bit more scared than we need to be. But who knows? We don't know at this point.
I want to come back to this and ask how you mentioned you're a little bit fearful, sort of how you're operating your business in today's environment. Before we answer that, though, we talked about how you got your start flipping houses, but then you transition into syndicated multifamily deals. So can you tell us a little bit about that transition and what that looks like?
So I am a business guy. I'm not a real estate guy. And a lot of people, when I say that, kind of look at me and laugh because I've done a lot of real estate transactions. But at the end of the day, I'm not the person that you want on the ground leading your real estate team. I'm not the person you want managing contractors or swinging a hammer or even leading marketing and sales and all that sort of stuff. I'm the guy that you probably would rather have at the top, the CEO type, that's figuring out the strategy, that's figuring out the systems, the processes. Maybe even a COO is a better description. I'm the person that you kind of want leading the ship, not the person that you want hoisting the sail, for lack of a better metaphor there. And so the way I was able to grow my flipping business from 2008 to 2016, my wife and myself, is we were really good at building systems, building processes, hiring people, surrounding ourselves with people that were really good and kind of treating it like a business, not like a real estate business, but like any business. And I wasn't involved in the day-to-day. I wasn't involved in managing the contractors again or doing any of the day-to-day stuff. And so it went well for 5, 6, 7, 8 years, but we got to the point where we couldn't handle the scale without creating a lot of issues that would have required me to be kind of in the day-to-day issues. Basically, we were able to scale a good bit without having to put in too much thought, time, or effort. And we got to the point where the next level of scale really would have been difficult. And after 8 years of flipping houses, I was a little bit burned out and I just wasn't ready for that next challenge. And so I said, hey, I'm going to pull back and I'm going to find something else to do. And for a year or two there, I actually thought about going back into tech. I do some advisory work. I thought about going and doing full-time advisory work. And after we sold all of those flips that we're holding, while I was trying to figure out what to do next, we ran into a little problem. We had all this cash that came back to us. We had all this cash sitting in the bank. And for 8 years, it never really occurred to me that we had all this cash because it was always deployed. And suddenly we had all this cash sitting in the bank and we needed something to do with it. And I couldn't figure out what to do with it. And so I started investing passively in what are called syndications, which is basically large real estate deals where you pool passive investors to buy a property. The passive investors have no voting rights. They have no day-to-day decision-making. Basically, you turn over your money and you hope to get a big return. As someone who is kind of a type A personality and doesn't deal well with other people controlling their money, that was hard for me. And so I wasn't really comfortable investing in other people's syndications. But what I realized was that this whole syndication model of doing large real estate investments was something that I think I could really enjoy. And it provided me that additional benefit that while I could be the operator, the person that's putting together the syndication, the person that's running the deal, I also have all these passive investors that are putting money in. I could also be a passive investor in my own deal. So I have basically this vehicle, this passive investment vehicle, where I'm also the person operating the deal. So I don't have to trust somebody else to be doing the right thing and operating the deal well. And so I decided this was kind of the path I wanted to take. I reached out to a good friend of mine. Her name is Ashley Wilson. And she's been in multifamily for a long time. And I basically said to her, look, I'll make you a deal. I'll come work for you for a year You'll have access to me, my time, my effort, my knowledge, my money, my network, anything you need for a year. All I ask in return is you teach me the business. And she loved that idea as much as I did. And so for a year, we kind of teamed up, and she taught me the business and I helped her with the deals that she was doing. And after that year, we realized that we had a tremendous amount of complementary skills. The things I was good at, she didn't like doing. The things she was good at, I wasn't good at. And so we said, hey, we could team up and we'd make a great partnership. And so 2019, 20-ish, we teamed up. We became 50-50 partners in her company called Bardown Investments. And we've been working together doing multifamily syndication ever since.
If you own rental units but don't want to pay for expensive software, check out Azebo, the smarter way to manage your rental properties. With Azebo, you can automate rent collection, find quality renters, simplify accounting and tax prep, get a bank account designed for real estate investors, and save on rental property insurance. All of these services are free through Azebo. Join thousands of real estate investors who trust Azebo to manage their rental business in one convenient platform. Sign up today at azebo.com/HRE. That's AZIBO.com/HRE.
That is awesome. I love that story, and I love that pivot, or I guess transition for you, because I think that it makes a lot of sense. That syndication business model makes a lot of sense with all the media that you've been putting together and the following and the audience that you've built as well.
Yep.
Just kind of closes out that flywheel, right? Or maybe not close out, but just adds another piece to that flywheel. So really love that.
Does.
Yeah.
And to answer Vicus's first question, which was what are we focusing on? What are we not focusing on? How are we kind of feeling out the market these days? What I like to say is when it comes to real estate investing and most types of investing, there are essentially two different types of transactions or two different types of deals. One is very transactional, where you buy with the intent to resell and you're making money by reselling. So you buy something for X, you hopefully add value, and you resell it for Y, and your profit is the difference between X and Y. And so the goal is really to be able to add that value short term and resell and make a big profit. The other way of making money in investing is to make money on the hold. So you buy something and you actually make money from cash flow by holding that thing. So rental properties is a good example. You buy a rental house and you rent it out and you get monthly cash flow. And then maybe at some point in the future, 5 years, 10 years, 50 years, you do sell it and you make a big pot of profits as well. But your goal was really that cash flow throughout. And so what I like to tell people is during economic times like today, that transactional model doesn't work well, because typically we're buying with the intent to resell. We don't profit until we resell. We're not generating cash until we resell. So if we can't resell quickly and for a profit, it's very possible we lose money. And in today's economy, we don't know what's going to happen 3 days from now, 3 weeks from now, 3 months from now. Maybe we know what's going to happen 3 years from now, but anything shorter than that, we don't know. And so if I buy a house today with the intent of flipping it, renovating it, and then reselling it, by the time I'm done renovating it in 2 or 3 or 4 months, the market may have gone down 10 or 15% in a worst case. We sold that in 2008. And on a typical flip I was doing, my profit margin was somewhere around 15%. And so if the market drops 15%, basically my profits are gone. I've worked for nothing. If the market drops more than 15%, or if I don't sell it quickly enough and I have all these holding costs that continue to accrue, potentially I start to lose money. And so a transactional investing model at this point in the market cycle tends to be very risky. On the other hand, a buy and hold type model is never risky. If you can find something today that cash flows, if you can find something today that's generating income for you month after month, it's not losing you money, it's making you money, you can be pretty certain that in 3 years, 5 years, 10 years, worst case, the market's going to return and values are going to come back up. I often talk about the fact that if I were to buy a $100,000 property today and my plan was to use it as a rental, I don't care if the value tomorrow is $50,000 or $25,000 or even zero, because I'm not planning to sell it. In fact, if the value goes down that much, I'm probably going to save on insurance. I'm probably going to save on taxes. I'm probably going to save in other places. So I don't care about what the value is tomorrow or next week or even next year. I obviously want the value to go up over time. But if you look at real estate, there's pretty much been no 10-year period in the history of this country where real estate hasn't appreciated, and typically appreciates at the rate of inflation. So if you think we're going to have high inflation for the next several years, well, it's likely that real estate's going to do well long-term, or even better long-term. So I'm a big fan of, these days, buy for cash flow, and know that if you can make money every month for the next X number of years, at some point, you're going to get that big payoff as well. And in the meantime, not only are you getting the cash flow, but you're getting other benefits. This is the other couple of reasons I love real estate. You're getting tax benefits. So you're getting depreciation. If you have a big property and you're willing to spend the money, you can do a cost segregation. And you can, thanks to some laws that were passed a few years ago, you can actually take some big write-offs in the first year, the first couple of years when you're doing renovations. And secondly, the longer you hold that property, assuming you have a loan on it, you're paying down, or your tenants, even better, your tenants are paying down your loan month after month after month. So you're accruing equity every month. So we look at a rental property, and a lot of people just look at the cash flow number. And we know cash flows are relatively small these days because interest rates are high and values are high. So cash flow is going to be low. But when you then add in the tax benefits and the principal pay down every month, you actually get a decent return, not even including the fact that your real estate's likely to go up at least at the rate of inflation for the next however many years you hold it. So I really love buy and hold in general, and I love real estate as an asset class because it provides those additional financial benefits over and above just the cash flow.
And as a CPA who does all the tax planning and stuff for our clients, I will definitely co-sign on the tax benefits piece. But one thing that I wanted to circle back on is this buy and hold forever type of strategy. And you didn't say forever necessarily, but a longer time. You know, it's interesting. Our wealthiest clients at the firm, we have a handful of clients who have mid 9-figure net worth. So we're talking like, FU money type of stuff. These guys buy and hold forever. That's what they do. They never, they'll trade, but they'll trade through a 1031. They never actually pull the money out. They just leave it forever. And what I saw them do leading up to 2022, it was probably like mid 2022, they refinanced their properties. They pulled cash out to build their cash positions, but they retained the property itself. And I didn't really understand what was going on at the time because, like you said earlier, I'm 32. I've never actually seen a recession that I remember or recall living through. I was a high schooler in the 2008 crash. So I don't remember anything about that, but I saw them pulling all this money out, and now it makes sense. They're just building their cash position to continue holding their assets, to continue servicing the debt. But kind of to the tax benefits, you can pull that equity out via a refinance, and it's not taxable. It's not a taxable event for you. So you can really like if you buy and hold for a long time, you've held for 10 years, and then the next recession's coming. Well, you've got a lot more equity to cash out 10 years from now. Yep. Whereas if you're just trying to transact every 5 to 7 years, you never really let that equity build. The amortization schedule doesn't work in your favor. And so you kind of get to this point and you have to sell. You don't have any more room to cash equity out. I don't know. It was an interesting observation. I've talked to a few people about this. I've been to a couple conferences and I talk about this just, in one-on-one, and everybody's always shocked, like, oh, I would never do that. I want to sell in 5 to 7 years. And I'm just like, I don't know. I mean, I don't know if it's noise or signal, but we have like 5 of these people. That's what they do. They just hold forever. So it's really interesting to kind of hear you.
Yeah, and I'm speaking now to anybody in their 20s or 30s or even their 40s. I remember, I was in Silicon Valley. I was a high earner. I was making high 6 figures with stock options for a long time. And I remember every year having to pay taxes. And there was a pretty hefty tax burden. And so I kind of went through life just feeling like taxes is a necessary evil and there's nothing I can really do about it. I remember talking to some tax folks back when I was in the tech industry and I had some really large tax bills and they're like, yeah, there's not much you can do about it. And I probably should have talked to more people. I should have talked to you, Brandon. Or you guys. But I remember at the time just not even thinking about taxes. It's just like, this is a necessary evil. There's nothing we can do about it. And here I am 15 years out of that industry in real estate. It took a few years, but a few years in, I started to recognize the fallacy in my thinking and that idea that taxes are just one of those things that you pay and you can't worry about it. And even if I could save a few dollars here and there, does it really matter? And what I've realized is it absolutely does. I released a book a few months ago called Real Estate by the Numbers. And I talk a lot in that book about the power of compounding, and basically how money saved today, time value of money earned or gotten today is worth a lot more than money earned or gotten 5 or 10 years from now, because the money we get today, we can invest it and we can compound it. We can reinvest and reinvest and reinvest. And what people don't realize is if I save $5,000 in taxes this year, it's not $5,000. It's $5,000 plus whatever I make from investing it and then reinvesting it and then reinvesting it. And over the next 10 years, it's going to be $10,000. And over the 20 years, it's going to be $50,000. It compounds. And so what people have to realize is saving on taxes is not a one-time event. It's a recurring event. And if you can save one time, you can make a lot more than just what it looks like you're saving. I don't know, I didn't explain that well, but it's a tremendously powerful idea.
No, you explained that really well, and you're speaking my language. And that's something we try to explain when we're talking about cost segregation and bonus depreciation to our clients. Because sometimes we get people that are like, well, I have to pay the depreciation recapture when I sell. But then it comes back to, do you have to sell? Why not just 1031 and continue doing that forever and then die
Absolutely.
And then pass it down to your heirs who get a stepped up basis and it all goes away. So you get the bonus depreciation up front, which means you get the tax benefits today. And even if you pay the depreciation recapture at some later point, you've reinvested the tax benefits up until that point. So to your point, a lot of points, it's compounding.
Yeah.
So you're speaking my language there. Now, I do want to circle back to something that you said. You said that you're a little more fearful today. How is that fear changing how you underwrite deals, how you operate your business compared to the last couple of years?
Yeah, the last couple of years, if I saw a deal, and I figured I was going to hold that deal for 3 to 5 years, I would underwrite the deal 3 to 5 years out. I might do a sensitivity analysis that said, if cap rates change a little bit, how's that going to impact my returns? If my income I can generate changes, how's that going to impact my returns? I might do that sensitivity analysis. But if I was planning on a 3 to 5 year hold, that's pretty much the model that I was going to create. Today, I'm much more in that line of thinking that the best laid plans. I might think 3 to 5 years is my hold time, but what happens if I have to hold 7 years? What happens if I have to hold 10 years? How does that impact my model? And more importantly, how does that potentially introduce catastrophic risk into the deal? We're seeing this a lot today with people who back in 2020, people were saying, I can get a floating rate loan, a 3-year floating rate loan, because no way. I mean, interest rates might go up, but there's no way interest rates are going to 5% or 6%. And here we are 3 years later, and interest rates are at 5.25%. And that's the federal funds rate. Mortgage rates are at 8-9%. And so there are a lot of people who back in 2020 were underwriting to that 3 years. They weren't thinking about that potentially catastrophic situation. And now they're in a situation where their loan's coming due. They can't refinance the same amount out because the value of the properties dropped. So their loan to value is at the same loan to value. The amount that they can refi is less. Their cash flow is going to be less because they're now moving into a higher interest rate loan. They're paying more for these things called rate caps, which are these insurance policies that you have to buy when you have a floating rate loan. And so all of these things conspire to basically put people who bought in 2020 with floating rate loans in a position where they're either going to lose the deal, or they're going to have to go to their investors or themselves and say, I have to put in a whole bunch more cash to keep this thing going. And that's a catastrophic risk. And so we have a lot more of our investors who these days rightfully are saying, how are you mitigating against catastrophic risks in the deals you're buying today? What are you going to do if we get 3 to 5 years down the road and interest rates are at 10 or 12%? And I'm sitting here thinking, there's zero chance interest rates are going to be at 10 to 12%. And then I remember It's the same way that people were saying 3 years ago that there was zero chance interest rates would be at 5 or 6%. So you have to recognize that as unlikely as something like that happening, there's still a possibility. And investors want to know, what is your plan? What is your mitigation if something like that happened, however unlikely it is? And so these days, what I find myself doing is running a lot more risk scenarios, sitting down with my team, my underwriters, my analysts, my partners, and saying, what are all the things that we think are like zero chance of happening, but aren't really zero chance of happening? And what would we do in those situations? So that way we're comfortable investing our money, and we're also can tell our investors, here's our mitigation for all of these potential things, so that hopefully they're comfortable investing their money as well.
I've been reading a lot of articles that have been talking about exactly what you just mentioned about people who borrowed money 3, 4, 5 years ago. Loans are coming up, and it's going to be a challenge for them to finance their properties. Are you anticipating like a sort of target-rich environment for distressed deals, or how are you thinking about that?
Yeah, so a couple things that we're seeing. Number one, in theory, that should be the result. We should see a lot of distressed deals. But what we're actually seeing right now, and I don't know for how much longer this will last, but right now banks are doing a really good job of working with borrowers to avoid major defaults. I suspect it goes back to 2008, where banks were kind of blindsided with all the foreclosures. They had to take back a lot of properties. It messed up their balance sheets. A lot of banks went out of business. A lot of other banks had to stop making loans because their balance sheets were not aligned well with liquidity and risk. And so I think there are a lot of banks right now that are hesitant to start taking back properties or being too aggressive with borrowers that are having problems. And so what we're hearing from a lot of brokers and both real estate brokers and mortgage brokers these days is that banks are working hard to ensure that borrowers stay solvent. And so instead of doing what they would normally do, which is the first round of like when you're not being able to pay your mortgage or you're not generating enough income, the first thing the banks typically do is this thing called lockbox, where they say, hey, instead of you collecting your income, now we're going to collect all your income from your tenants. We'll dole that out for your expenses as you need it, and we're going to control basically your cash flow for your property. And that's not a good place to be, but it's better than the next step, which is basically foreclosure or having to figure out a way to restructure the debt. These days, it looks like banks are trying to avoid both lockbox and foreclosure. And so they are doing some short-term adjustments to loans to ensure that that borrowers are able to stay solvent, continue to generate cash flow, continue to keep reasonable DSCRs, which is a ratio that basically talks about, it's a ratio that indicates how easily an owner can pay their mortgage. And so it looks like banks right now aren't going to let a whole lot of operators fail. And so I don't think we're going to see as many distressed deals in the next 3 to 6 months as I think a lot of people are expecting. That said, at some point, we're going to see enough of these properties that are running into issues that banks are going to have to start taking action, whether it be selling the notes, so basically forcing a sale of the property, or foreclosing, or in some other way stepping in to facilitate a transaction that allows the lender to be put in a safer position. And so I think when that starts to happen, and again, I think we're probably still 6 to 12 months away from it, I think we are going to start to see more deals. Now, that said, I think we have a lot of pent-up demand as well. There are a lot of buyers right now on the sidelines that have a lot of money. So while the market might be struggling, there are a lot of people out there with a lot of cash who are basically saying, I want to buy real estate. I want to buy real estate. I'm seeing it in my business. I'm talking to other operators who are seeing it from their investors. So many people out there that are struggling to place cash really want to do it in real estate. And so I think once those deals start to present themselves, there's going to be a ton of demand for those deals. And so I don't think we're really going to see that spiraling downward like we saw in 2008, where a lot of distressed sales and foreclosures led to values going like just dropping like a rock. I think instead we're going to start to see the bank giving up on some of these borrowers, taking back some of these properties, but there'll be plenty of people like me and other operators who have the ability to step in and take it over at reasonable terms and reasonable values. So I don't foresee a major, I wouldn't even use the word crash. I don't even see a major downturn past what we've already seen in the multifamily space. Likewise, in most other commercial asset classes, I think things are relatively strong. Self-storage is still strong. Warehouse is still strong. Mobile homes are pretty strong. Certainly, we're seeing a lot of issues, and I think we could see some major issues in things like retail and office and malls. Those are all kind of starting to collapse around us. But I think in the residential space and the more traditional commercial spaces, I don't think we're going to see any major softening or any amazing availability of deals that people are hoping to get.
Good for some, not good for people who have a lot of cash that are looking to buy, right?
Exactly.
Now, you mentioned something earlier about local markets, and I know that you've spent a lot of time studying the economy, writing about the economy, speaking on the economy. I always love listening to your stuff. So my question is, what do you think makes a local economy resilient during a recession? Because like you said earlier, the entire nation could be having a recession, but it doesn't necessarily mean that your local area is hit as hard, or it could be hit harder. So what do you think makes a local area, city, however you want to define it, more resilient during a recession?
Yep. If you were to look at our spreadsheets that we use to analyze markets, you would see dozens, if not hundreds, of data points that we look at. That said, there's really only 4 that really matter. Once you get past these 4, everything else is kind of the long tail. And so the 4 that and it's not just us, this is, I think, for most buy and hold investors, the 4 that we like to look at are, number 1, population growth. So we want to know that there are a lot of people moving to the area where we're buying, because those are our customers. And the more potential customers you have, the more demand you have, and obviously the more demand you have, the higher you can raise rents. So population growth is by far the number 1. Next is employment.
Can I actually ask a question on that?
Yeah.
Is that why a lot of people, I feel like over the past few years, I've seen a lot of syndication groups move into Texas. Is that one of those reasons?
Texas, Florida, the Southeast, some areas in the Midwest, 100%. Because if you look at population growth trends, Texas, Florida, North and South Carolina, those far surpass other parts of the country. And so there are a lot of people that don't get past that first criteria of population growth. And let me tell you something, while it's important, again, I could list 100 different data points that you should look at. If you looked at nothing other than population growth, you're probably relatively insulated from the worst of the macroeconomic repercussions. I'm not going to say it's smart. I'm not saying only look at that, but that one is so far and away more important than all the other ones that's the first one everybody's going to look at. That said, there are 3 others that I think are super important. Number 2 is employment growth. So what drives population growth? Well, in the COVID world or the COVID days, population growth is driven by where people want to live and where taxes are low, because a lot of people are working from home. A lot of people can live anywhere. And so where have they gone? They've gone to Florida. They've gone to Texas. They've gone to North Carolina. There's a world outside of COVID where people actually go into the office. And so in areas that are seeing employment growth, that are seeing industry and business growth, we're obviously going to see population growth, because as we see more employers, people are going to have an incentive to move in. When we see big employers move in, they're going to bring people with them, or they're going to hire from around the country and move people in. So employment growth is that next big one. So go research at your local chamber of commerce to see what big companies are moving in, and see what types of incentives, local and county incentives, are being made for businesses. Is it a business-friendly area? So that all plays into the business growth or employment growth. Number 3 is wage growth. So we like to see certain industries moving into areas more so than other industries. So we want to see those industries that tend to have the highest wage growth. Obviously, tech is one of those big ones. So employment growth in general is great, but if we can see tech growth in an area, that to us is going to be even better because we know that we tend to see higher wage growth in the tech industry, as well as certain other areas. So wage growth is number 3. And then number 4, and this is a big one for me. I don't hear a lot of people talking about this one, but this one is super important to me, having invested through 2008, employment diversity. So what we saw in 2008 was that there were some areas that got hit much, much harder than other areas. And if you look at those areas that got hit the hardest, they all have, not all, but most have one thing in common, and that's a lack of employment diversity. So you look at an area like Las Vegas. Las Vegas is based on tourism. Las Vegas is based on hospitality. And when 2008 came around and people didn't have disposable income and they stopped going on vacation and they stopped gambling and they stopped going to Vegas, Vegas's unemployment rate went through the roof. And that high unemployment led to a lot of issues in housing. And so we saw the same thing in Orlando, Florida, where Disney is located. We saw the same thing in a lot of other touristy areas. You think back to the 80s in Detroit. And we all know what happened when kind of the automotive industry kind of moved out of the U.S. Detroit got crushed and basically never recovered because it was a one industry town. And so I'm very cognizant of when we invest, we should be focusing on areas that have this employment diversity so that if one industry gets hit really hard, or worst case, one company gets hit really hard, and General Motors gets hit really hard, I don't have to worry about the whole area basically experiencing high unemployment and that crushing the real estate market. So population growth, employment growth, wage growth, and employment diversity are the 4 things that I look at.
That's such a great point about employment diversity. And it actually makes me think, I'm pretty sure I'm not making this up. You can correct me if I'm wrong. Didn't Washington, D.C. fare pretty well during the 2008 crisis? Because, I mean, they're all still employed.
Yeah.
Did I make that up, or is that true?
D.C. fared tremendously well. Values in D.C. did tremendously well in 2008. There was a lot of, I remember hearing a lot of arguing over why that was. Some people saying that it was because obviously politics and people that live in D.C. tend to have to live there. They also tend to be people that tend to be more wealthy, especially when they're in politics. But D.C. also has a pretty vibrant economy in general. And over the past, well, definitely from like 2000 to 2010, saw tremendous employment growth. A lot of businesses moved in. We also had Northern Virginia that saw a lot of tech growth, and parts of Maryland saw tremendous tech growth up the 295, I think it's 295 corridor. And so there was a lot of growth in that area between 2000 and 2008 that continued, and I think propped up that area a good bit during the 2008 recession.
So I know you said that there's probably 100 metrics someone can look at, and these are the top 4. There is one other one I do want to ask you about as someone who has spent almost his entire life in coastal California. Do you look at supply side factors like housing permits,
Absolutely.
ability to build?
Absolutely. And so
anything like that?
That tends to be more, when I say local, hyper local. So when people move to, for example, we live in, or we invest a lot in Houston. We have a lot of apartment complexes in Houston. And when we look at Houston as an MSA, as a kind of a market in general, we look at those big 4 things. But when you start to look at specific properties, that's when it's really important what's being built around you. Because we don't have to worry about somebody, if we're investing in Northwest Houston, we don't have to worry about an apartment complex in Southwest Houston or Southeast Houston really impacting us because it's such a big area. That's not going to steal tenants from us. But when you start looking at a granular level of particular properties, you're going to want to be very cognizant of what's called housing starts, which is basically permits for building and what's coming online. Because there's this concept that I don't hear talked about nearly enough, but it's called absorption rate. And absorption rate is basically not only how many people are likely to be tenants for your particular complex, but how many of them are actually going to be tenants for the specific unit mix that you have in your complex? How quickly can you absorb them? And so a good example is I could find fastest growing place in the country, the most population growth, the most employment growth, the most wage growth, the most employment diversity. And I wouldn't necessarily buy a cheap apartment complex that had all 1 bedrooms if the only people moving in were families that needed 2 and 3 bedrooms. And vice versa. I wouldn't buy really large units, 1,200 square foot units, when everybody that's going to be living there is going to be single people who basically are living there because they have a local job. A good example is when I lived in Northern California. There were a lot of apartment complexes that look a whole lot different than the apartment complexes you see around the rest of the country, because there are a lot of people that were like me. They were single guys who moved there to work 80 hours in the tech industry. And I didn't need a 4-bedroom apartment. I didn't need 1,200 square feet. I needed the cheapest 1-bedroom, smallest thing I could find that I could afford. And so it was unlikely that if somebody were to build or buy a whole complex of 3-unit apartments in Northern California, that you're going to get the same absorption than you would as 1 bedroom. And so it's really important to know what's being built around you, because what's being built around you is going to impact your absorption rate, your ability to get tenants in. So knowing both what's being built around you and also knowing the types of potential tenants you have that will be moving into your units, because that's what you need to be designing for.
When you are looking at starts and absorption rate, what radius are you looking at? Are you like a mile, 5 miles?
It's gonna depend. This is not my area of expertise. Luckily, I have an amazing partner again, Ashley Wilson, who is the king or queen of what's called asset management, being able to manage the business plan for properties. And part of that is understanding the competition, understanding absorption rates, understanding what's being built around. And so she manages our team that handles all that, and she's amazing at it. But I will say that there's no one size fits all. A lot of it is as much art as it is science. So if I were to buy an apartment complex in one part of Houston versus another part of Houston, the question is, people that are living in the first apartment complex, where are they working? So is that apartment complex near the major hospital center in Houston? If so, we're probably going to have a lot of people that are going to be working at the hospital. And so they're going to want proximity to the hospital. And so a lot of them are probably going to be living there because of the proximity. And so the radius is going to be smaller than if we're in another part of Houston where most people are going to be living in that apartment complex and driving a half hour to work. Because if you're driving a half hour to work, well, what's an extra 5 minutes or 10 minutes here or there? And so we're going to have competition from a much larger radius of property. So it's really important that you're looking at the specific property that you're considering purchasing, and you're actually asking yourself, the people that are living here, who are they? Where do they work? What's the size of their family? What is their age? What are the types of amenities that they want? So then you know exactly what you're competing with. Are you competing with the properties within a mile radius, or 5 miles, or 10 miles? Or maybe literally you're competing with just these 3 others because they're all walking distance to this university campus, where the only people that are living here are people that probably don't have cars, but they work on the campus. And so lots of details there. And again, this is far from my area of expertise, but I would say that make sure if you're investing passively that the people you're investing with have this expertise, or if you're investing actively, that you have people on your team that really understand this really well.
I just love that, like, listening to you versus others. You know, there's always the macro kind of big idea of real estate investing, but you've been very successful in your real estate career, and listening to you talk, you can see why, because there's just so much information that you're analyzing and looking at. I mean, even just right there in the last minute and a half, you just threw a ton at us that wasn't even in the beginning of the podcast. So I think it's just really important for everybody listening that, you know, you can be successful by looking at the macro environment and in just kind of buying rentals and scaling a portfolio. But you can be super successful if you really start diving into all the details. And that's what you're competing with if you try to go and compete with people like Jay and his team, right? So you got to be ready to play at that level if you want to be super successful at that level.
Well, I appreciate that.
All right, so we are running out of time. So I've got 3 closing questions for you. The first is, what is your favorite book? It can't be one of the books you wrote, but I will ask you what's your favorite book you wrote here in a second.
So my favorite book, I've got a lot of favorite books. There's 2 that come to mind. I'm going to pick one. I flip back and forth. Okay, today I'm going to go with Thinking Fast and Slow by Daniel Kahneman.
Good book.
So amazing book. It's not real estate or investing related, but it really talks about how the mind works, how the brain works, how people think about things. So you can really get into the minds of your customers, your partners, your competitors, your wife, your friends. It really helps you start it helps you gain a little bit of empathy for how people think.
Love it. And which of the 4, I think, books have you written? Which one is your favorite? Which one was the most fun to write?
So I'm going to go with number 5. So I did release a new one a couple months ago. It's called Real Estate by the Numbers. And it took me about 5 years to write. My co-author is Dave Meyer, who is VP of analytics at Bigger Pockets. And it's basically a book all about, some of the concepts we talked about. So time value of money, compounding, and then all the math and formulas and finance and high-level analytical concepts that go into investing. And then it dives deep into how you actually analyze deals using these concepts. And again, it was a really hard book to write, but it's my favorite. It's called Real Estate by the Numbers.
Real Estate by the Numbers. I've heard of this book. Isn't it like a textbook? The thing's thick, right?
It is. It's by far the biggest book Bigger Pockets has ever published at
Amazing.
like close to 400 pages. And I'm an engineer by trade and mindset. And so I'm not good at writing fluffy motivational stuff, but I am good at writing stuff like this. So yeah, it probably is more like a textbook.
And I should clarify, I've heard nothing but good things. It's a good thickness. It's a very good.
It's a book that you probably won't read cover to cover. You'll probably skim it cover to cover, and you'll come back and use it as a reference guide hopefully 1,000 times. Love it.
All right. Well, that was all question number 1. So question number 2, if you had to pick cash flow or appreciation, what are you investing for? Cash flow or appreciation? You have to pick one.
They're the same thing. It's like it's ice and water. They're the same thing in different forms. I can convert cash flow to net worth, and I can convert net worth to cash flow. Just take it and invest in something else. But at the end of the day, I'm always going to come back to cash flow. At the end of the day, I like having cash in the bank. I like seeing. I feel I sleep better with cash in the bank. But at the end of the day, I realize cash in the bank is absolutely worthless. And today with high inflation, it's less than worthless. And so I'm always going to come back to cash flow.
Good. Okay. Yeah, they are the same thing. Jay is picking the red pill, breaking the matrix. Of the, all right. Question number 3: if you had to give one tip, knowing where we are at today with the market and everything that you've seen of your career, one closing tip to all of our listeners, what would that be?
Today, meaning like right now, today, maybe even the next couple months, is probably not the best time in the world to invest. But the time that's going to be great to invest is coming up soon. There's going to be some tremendous opportunity in 6, 12, 24, 36 months. I don't know exactly when, but at some point soon, there's going to be some tremendous opportunity. So take this time now, between now and when that opportunity comes, to start learning, to start building your network, building your knowledge base, go out and build your credit, find partners that you can invest with, find people that you can learn from. Now is the time to be preparing. There are too many people that are like, now's a bad time to invest. I'm going to go focus on something else. I'll come back. Well, you're going to come back, and now you're going to be far behind everybody that just spent the last year studying and preparing. So start studying and preparing now.
Jay, thanks so much for coming on. If people are listening to this and they want to reach out, contact you, where can they go to do that?
connectwithjayscott.com, www.connectwithjayscott.com, and that will link out to everything you might be interested in.
This was an awesome show. We really appreciate your time, and we'll see you on the next episode.